Hello, this is Jed Brewer with Study Groups. It's very nice to have you on the call today. Really excited to be talking about mergers and acquisitions and also a legal update at the same time. A lot of change has been taking place in our industry. Consolidation continues to be a trend, and really want to hear from the experts on some of the things that they're seeing out in the marketplace. Interest rates have moved up. We've had a change in uh, president, and other variables that are impacting the industry. So what, if any, change is there on M&A activity as a result of some of these things? Two experts on M&A, Spencer Cavalier, who's the co-head of the downstream energy and convenience retail segment of Matrix, as well as Sean Dooley, who's a managing director at Matrix Capital Markets Group. They're going to talk more on the M&A aspect. And then we have Jim Durkin, who's a lawyer at Winthrop and Weinstein out of Minneapolis area. Jim will be giving us a legal update and really getting into the corporate veil. A lot of us have segmented our companies. Maybe we have our transportation division and a separate LLC. What implications of that corporate veil are out there? Could things possibly be pierced? Is it structure? What do we need to do to really keep that corporate veil firm? Jim will be talking a little bit about that here and best practices surrounding it. So I'm not going to spend too much time talking here. I really want to get into the meat of the content, but Matrix, Study Groups, and Winthrop and Weinstein, we were talking just a little bit before this call, and 2025 is Study Groups' 40th anniversary as a company. So we're really proud and excited about that. I appreciate your support and helping us get there. But Matrix, they've been in business for 38 years. And Winthrop and Weinstein, Jim was telling me they're 46 years as a company, have 180 lawyers as part of their team working with study group members across the country, as well as people in other industries. So a lot of experience here on the call, and just grateful that these experts are willing to take their time to help us educate. We want this to be as educational as possible. To that vein, if you have a question, you're on mute, but please type that into the dialog box and go to webinar. I'll be able to read that question and I can pass it along to our presenters. We're going to record this and we'll provide the slide deck and recording out if you want to view any of the materials, because we're going to be moving through things pretty quickly here today. So with that brief introduction, mergers and acquisitions, where's the market at, both retail and wholesale propane lubricants? Spencer Cavalier at Matrix, I'm going to turn the floor over to you.
Thank you, Jed. Yeah, we like being referred to as the Matrix, so that's a fun way to start. And we're really excited about the opportunity to present again this year. And I know I speak for Jim that we're honored to participate. We heard some requests from people this year about content, so we actually added some additional slides, Jed. And so we're going to move with pretty good pace. Some of the slides it's more for a leave behind, but I'm happy to answer questions after the webinar on any of the slides that we present today. So with that, we're going to start with, you can see the discussion topics here. We're going to start with the M&A activity kind of for all sectors, then kind of drill down into these other sectors that we cover a lot, retail, wholesale fuels, propane lubricants, and then the legal update, the corporate veil. So if you go to slide 4, you can see that this is all sectors. There's 7 primary sectors of the economy, and you can see the volume of deals done across all those sectors. And so last year, 2024, deal count was up about 10% over 2023. There's a little softness in the last quarter of the year. I think that was due to the election and some uncertainty there, but we saw valuation expectations come to be more aligned with each other between buyer and sellers. We had an adaptation to higher financing cost. We saw better credit availability, capital availability overall. There's a lot out there. And although there was some inflation, which we're going to talk about in a little bit, people seem to had a more positive outlook on the economy, especially with the potential change in the administration. So it was a strong year overall. This is all sectors, not the sector we're going to talk about today. So if you move to the next slide, Sean, we're going to focus on retail and wholesale fuels. And if you remember from last couple years of how Matrix defines downstream energy and convenience retail, so we cover a number of industries, and you can see them on this slide. And those, petroleum marketing, distribution, convenience retail, propane, terminals, heating oil distribution, lubricants. What we're focused on in the next few slides is just wholesale fuels and convenience retail. So then we can go to the next one. So we always have this slide in here because we like to start with the factors driving consideration. And I'm not going to hit on all these bullets because some of them are a repeat, but I want to hit on some of the things I think are most pertinent this year. So factors driving consolidation that are likely to be permanent. The second bullet, continued expansion by highly recognized C-store brands with established loyalty programs in large format stores. We see, and we see it in the numbers, a lot of traction by these larger format stores and people being very loyal to those loyalty programs. And that is taking traffic counts from some of your more traditional convenience retailers and making these larger format stores with established brands a destination, even more than they used to be. And we're going to get into that a little bit more later. Sean's going to talk about that. About the fifth bullet down, ability to attract and retain employees. We hear about this constantly from our clients that maybe a little bit smaller relative to our larger clients, that they're having a harder time attracting and retaining employees because they're competing with employers that offer a greater breadth of benefit programs, maybe a higher wage, maybe just more upward mobility within a corporation. So we're hearing that. The next to the last bullet, which is we think is permanent, is generational issues. We always have to mention this because we have such a fragmented, large industry, and it's a lot of companies are privately held. There is still a continued issue with lack of transition to the next generation of a family that we always deal with, which is natural in all different industries, but we see it here a good bit. And then we see the continued decline of liquid fuels demand. And and we'll talk about this a little bit more why we think it is, but I think we believe it's a lot to do with ICE efficiency. The vehicles are more fuel efficient, and then EV and hybrid market share does continue to grow. Maybe the growth has slowed a little bit, but it does continue to grow. Factors that are subject to change. The first one being a major one. TCJA was passed in 2017. Everybody knows about the accelerated depreciation to be able to write off things in the first year. So we're down now to 40% in 2025 and 20% in 2026. If he's not able to extend TCJA, I know that's his intention, and that would be a very good thing. So we think that's going to change back to 100% write-off. We're uncertain about.
I was visiting with some study group members recently, and they were talking about possible retro action of that 100% depreciation, maybe even to 2024. Have you heard of any talking around that?
Yeah, I have read that, but I don't want to get too excited about it, but that would be wonderful. I would just like to see it reinstated going forward, but I don't know if that will happen. So fingers crossed. Uncertainty over regulatory mandates. So, there's a lot of people very positive about the new Trump administration. There's going to be, maybe less regulation and less electrification type regulations or mandates. And some have been pulled back already. The issue here, though, is that for us, from what we see and read, car manufacturers have kind of already moved on to hybrids and EVs. Some are dedicated to EVs, as we all know. So while our administration is favorable, the car manufacturing industry has kind of turned the tide. And so we're very interested in seeing what that means for the future, even though there's maybe less regulation over the next 4 years. And then the last bullet I'll hit are inflationary pressures affecting inside sales volumes and consumer trips. This is something we watched all last year. We've heard it from many of the owners and executives of companies. We think this will change when inflation goes down and people have more discretionary income, but people are certainly being more irrational. They're just being more deliberate about, what they're buying everywhere in any type of retail environment. And it seems like the convenience channel is feeling that a little bit as well. Next slide, we're going to talk about M&A activity historically. Now, we go back many years and we have a criteria where we track transactions that have to have at least 10 convenience stores or 25 supply accounts or 2 truck stops. We don't include sell-leaseback transactions, things of that nature. But since 2014 from 2014 to 24, we've had about 36 deals a year completed. Last year we were down. We were down, and these are closed deals, not announced. We had 30 closed last year, the way we track transactions. But there were a number of large transactions, for example, the Fikes Casey's deal, Andretti H&S Energy. Some deals announced but not closed, like the Giant Eagle deal. It was a very large transaction. So a lot got done last year, or a lot was worked on last year, but the closings were down about 6 transactions. Where do we go this year? I think we'll probably be right around average to above, because based on the work we're doing and the pace, I think it's going to be around that. But we had one, we always like to say this, from the beginning of 2021 to the end of 24, a lot of unique buyers. There's 81 unique buyers out of the 160 closed transactions that we track. So
Spencer,
still a lot of activity.
Like the average deal is getting larger just as the industry consolidates. Do you find the sort of timeline from start to finish is getting longer for your organization in part?
For those larger transactions, absolutely, because of the Federal Trade Federal Trade, FTC, and DOJ review. That really adds on typically a couple months to maybe 3 months to go through that. Some deals even longer. So yeah, it takes longer to do those larger transactions when it's above. Sean, I think it's 100, or maybe Jim's the better person, but 126 million is a threshold value, enterprise value for filing. So
I think that's right, Spencer. Last I checked.
Next slide. So we don't publish multiples, and we don't send out multiples to people on our private deals. We use the publicly traded companies as a guideline, and we have more than ever, which is fantastic. We can see trends. And so what we have here, though, another caveat is these are corporate EBITDA multiples divided into enterprise value versus what you hear a lot in the market about asset-based EBITDA multiples, which are typically a little bit lower. But on average, you can see from 2015 to 2024, for the public companies that are in this set, it's been about 10 times, and sometimes it's higher. Right now, towards the end of last year, we were over 11 times. Again, that's a corporate level multiple with all the expenses in there, so it pushes it up a little bit. Driving this market over the last few years has really been Circle K and Casey's, to some degree Murphy and Global. They've really had really good, strong growth in their equity capitalization. So the trend is we're above our average for the last 10 years, and I think that it's strong. I think I think Jed's probably getting ready to ask me, does that count for every company? No, this is really for the higher quality businesses that we see transact, but still multiples are still good. Even in the 8 to 10 corporate level, it's a pretty strong multiple historically. Next slide. We had some questions about, over the last year, we've seen the wholesale dealer or wholesale transaction multiples go up a little bit. And so what we decided to do was provide some multiples on an anonymous basis based on per account type metrics. And if you look at this, on the left-hand side, you'll see fuel volumes, purchase price per account, EBITDA per account, EBITDA per gallon, stuff, all those key metrics. And then if you look across and just compare client C and client F, you can see that there's really a big difference where client C may have an average of 1.8 million gallons per account, and EBITDA is about 45,000, and both of those are higher than client F. And you would think, wow, that multiple is low, that EBITDA should be different than what it is. However, what we're seeing driving values in this market, it's really spread out in terms of the range of values. But what's not reflected on the slide are the two main drivers: is contract duration, how much time is left on the contract, even though there's a probability of extending the contract, and the ability to lift EBITDA. And so if you turn to the next slide, we are seeing more than ever a big differential in larger fuels distributors' ability to secure fuel supply agreements with major oil companies, whether they be branded or unbranded, but primarily branded, and that they're able to increase their margin between the rack price that they're publishing to their dealers and what they're actually buying at. And we've seen this over the last few years, but it's really coming through on the wholesale side now. There's more branding incentives than ever. We know that companies that have gotten larger on these asset-light businesses, such as these open dealer portfolios, have, when they can get these higher returns on invested capital, they're pushing to grow that volume, and they're pushing to do more deals in this part of this little segment of the channel. And it fell out of favor maybe a few years ago. People were still doing it, but they were really focused only on their direct channel. There seems to be more interest today in the wholesale dealer channel. And I think the last thing, people are a little bit more bullish because they think electric vehicle adoption is likely to continue, but the general consensus is that the rate of adoption is going to slow down. There's a longer life to these maybe lower volume dealer accounts, and they can be really good return mechanisms for many of our clients. Okay, Sean.
I'll ask you just quickly on that, Spencer. You're kind of talking about the EBITDA that the seller receives, and then
Correct.
There's EBITDA that effectively, after you synergize the deal, that the buyer is paying off their EBITDA that they're going to get out of the deal. That gap, that's where deals happen.
Right.
Is that gap changing as we have these larger consolidators, like a Circle K, a 7-Eleven, or is that gap kind of held pretty steady over time?
No, it's changing. We have other slides for that we can share, not right now, but it's changing because they just have such synergies and procurement advantages that they've enjoyed as getting larger, and then they're going together with. I think you've mentioned synergies by volume. They're going out to the market, maybe like Circle K is going out with Love's or Pilot, whoever the case may be, and bidding unbranded fuels together, right, and trying to get even better procurement terms. So the gap is widening in that regard, and sellers are enjoying when they share some of that synergy and value with them, and so that's why we're seeing larger deals get priced very well and high quality assets get priced well.
That makes sense. Thank you.
All right, moving on to slide 12 here. This slide really all depicted in the 4 different quadrants here, but it talks about the headwinds that the industry has faced while fuel gross profit has still remained quite resilient. So in the top left quadrant, we've graphed vehicle miles traveled, or VMT, and you can see here that 2024 levels of 3.3 trillion miles is roughly in line with 2019 or pre-COVID levels. You can see the dip in the COVID period to roughly 3 trillion miles, and then the rebound. So it's rebounded nicely since COVID and basically at pre-COVID levels for vehicle miles traveled. In the top right quadrant, we've graphed finished motor gasoline supplied in terms of barrels and millions per day. And you can see that it peaked in 2016, and then again, a gradual recovery from the COVID era lows of 8.1, and we're now sit at 8.9 millions of barrels per day, which is roughly in line with 10 years ago, 2014. So roughly 4% below the pre-COVID-19 levels, but in line with 10 years ago. So again, a rebound since the lows of COVID. In the bottom left quadrant, you can see the average vehicle fuel efficiency in terms of miles per gallon. No COVID dip here. You can see a steady increase since 2014 of 24 miles per gallon up to 28 miles per gallon as of last year. And this is basically a 1% increase from 2014 to 2020. And then you've seen a further uptick since 2020 of roughly 2.5% per year. So an increase in more recent years, as Spencer mentioned, the auto manufacturers have had a bigger push to higher fuel standards, higher CAFE standards, as well as EVs and other type of hybrid vehicles.
Sean, to that slide, now in your bottom right quadrant, you've got the big run up that we've seen in pool margins. They're off slightly year over year, but still historically very high. Our members who are on the buy side, there's been a lot of discussion around, boy, I have this target I want to go after. They're coming off record fuel margin. Should I pay the same 10 times or 8 times, whatever the multiple is on those higher fuel margin? It looks like people are paying that for the industry as a whole. Is that what you're seeing as well?
Yes, after COVID or coming out of COVID, people wrestled with that, meaning acquirers wrestled with that a bit. Our higher fuel margins here to stay. And to your observation, Jed, in the bottom right quadrant, you can see that pooled fuel margins, this is a national average for gasoline in cents per gallon, been roughly in the, call it 40 to low 40 range for the last 3 years. So when we at Matrix take a company to market, we typically show the last 3 years financial performance plus the trailing 12 months. So a potential buyer pool would see 22, 23, 24, and then some period into 25. And, you would see those elevated fuel margins in all periods. Are they really elevated? It seems like we've moved to a new higher baseline.
Mm-hmm.
Moving on to slide 13 here, talking again about fuel gross profit. You can see here that fuel gross profit has basically doubled the pace of inflation, even though inflation has been high recently. If you go back all the way to 2014, so 10 years, you can see inflation has been roughly a 2.7% compound annual growth rate, and fuel gross profit has been roughly double that of 5.5%. So, obviously that's been a boon and tailwind for the industry and help to offset some of the inflationary pressures that people have faced in terms of operating expenses. Moving on to slide 14 here and talking a little more about inside sales evolution and gross profit mix. You can see again the observation of fuel gross margins, both gasoline and diesel, being high over the last 3 years relative to historical norms. You can see their gross profit contribution percentage increased from 2009 of 32% in kind of that bright blue top right piece of the pie to 38% in 2024. So even though volume, as everyone knows, has been declining to some extent in different parts of the country, the margins have more than made up for the volume declines, and therefore gross profit dollars have increased, and the percentage of fuel as a contribution of total gross profit dollars has also increased. We also observed, and we'll get into this more on some coming slides, that food service has surpassed cigarettes as the largest category in terms of inside sales. You can see that their gross profit contribution increased from 15% to 20% from 2009 to 2024. And that has helped, since with food service, you have higher margins, vis-a-vis cigarettes. And that's also helped to offset partially, the increase in operating expenses that people have faced or operators have faced in terms of inflationary pressures and just, general trends. On this graph on slide 15 here, we've taken the same store inside sales percentage performance or change on a year-over-year basis. So these stats are reported by the public companies. So you can see Circle K, Arco, GPM, Casey's, Murphy, Parkland, and 7-Eleven. And we've graphed these on a quarterly basis back from 2021 through Q3 2024. And what key observations I'd take away from here is that you can see that Casey's, which is the red dot, and Murphy, which is, call it the gold beige dot or circle, they've outperformed their peer group. You can see they tend to be the highest two dots in a given period. and they also tend to be in positive territory in terms of year-over-year same-store sales growth. And then in terms of lower performers, you can see GPM ARCO, the blue circle or dot, they tend to be in the lower end for a given period and also in negative territory. So this is something the public companies report. The research analysts that cover the public companies tend to emphasize it, and we thought it would be, a neat depiction in graph form here. We haven't seen many companies do this, so hopefully it's insightful to the group here.
Yeah, it's interesting to see some of the weakness on same-store inside sales some are having. I know our study group trends are still up, but not up as much as they were. And then the question is, well, is it inflation? Is it real? Just a thought, the conversation we had was Ozempic, and how does it play into inside sales as a high portion of the population is starting to go on these weight loss drugs. So just something to consider. Absolutely.
And as Spencer referenced, and I think Jed, you spoke a little bit about earlier too, actual consumer trips, both to the fuel forecourt, but also inside the store. You got to get a consumer inside the store to transact in terms of merchandise. Those heavily influence these sales trends as well. So I know that 7-Eleven has reported consumer trips have been down. So that's a headwind. Got to get people inside the store to sell them the merchandise and get the gross profit dollars up. In terms of other areas where we're seeing growth, I touched on this a little earlier, but proprietary food service, that has been a big emphasis of the industry. And it's really a key differentiator and a destination magnet for consumers. So Buc-ee's might be perhaps at least the biggest destination magnet of all these companies, or at least facilities down here at the bottom. Quite the offering if people have visited Buc-ee's before, known for a lot of things. One of which is their brisket sandwiches and other food items. Casey's has been very successful with their pizza program, both in terms of to-go and delivery. Royal Farms, more of a mid-Atlantic brand, but famous for their fried chicken. And then Sheetz and Wawa, multi-regional brands that are famous for their made-to-order, subs and other various items. So this another great way to get people in the stores, get them going to your location as a prime destination in terms of what they want, and then sell them more items once they're inside the store. So these have been some of the more successful brands and their lead offering in terms of customer loyalty, customer retention, and getting them in the store and selling them more items.
And Sean, one member asked just on this sort of a softening trend on inside sales that some are observing, maybe the macro economy is still growing, but is it maybe our industry is under more pressure because other food service brands are pushing back?
That's certainly a force there, Jed. Here we've listed out proprietary food service offerings, but of course you have the national branded QSRs, some of which are, operated or employed by the convenience store channel, either inside the stores or side-by-side offering. So that taking away from proprietary food could be a national brand. Lots of convenience store operators have chosen one or the other. They go all in on their proprietary food service, or they think it's best to use a franchise brand and grow that way. And I also think, as we have alluded to throughout the presentation, a lot of the convenience store consumers have been hit in their pocket or wallet with inflationary pressures. So they have to stretch their dollar further, and where they choose to spend it, is more selective.
Mm-hmm.
Going a little deeper on proprietary food service here, you can see it's certainly a growing category for the convenience store channel, topping $88 billion in 2023 in terms of revenue or sales. And then in terms of the contribution to total inside sales, so excluding fuel sales, is 27%, which was the largest we had seen, or the greatest portion of the share over the last 6 years. So it's something to obviously pay attention to. You have to manage it carefully. We've seen a lot of potential clients have to go through some growing pains, managing waste and training employees. Employee turnover certainly doesn't help when you're trying to run a proprietary food service offering and you have to, have specialized training for employees. But it's something that can't be ignored. I think, again, it's really at a crossroads for convenience store operators. Do they choose to go proprietary, or do they choose to go with a national branded QSR or franchise branded and go to market that way?
So, Jed,
that
go ahead. Sorry, Sean. Go ahead.
I was going to say we covered a good bit of inside the store categories and performance there, and then I'm going to turn it back to Spence here to do some high-level observations in terms of electric vehicles.
So these next 6 slides were kind of a core request by some people that may be on this webinar, and these are, I'm going to go pretty quickly on these because these are kind of the leave behind slides. But we put some data together that maybe people have seen in other places, but we kind of put them all together here, and we did some our own nerd patrol on these to make sure that they kind of show what we think they're trying to say. But anyway, sales for the powertrain, you can see this year, 2024, about 16 million units, up about 2.5%. In the table in the middle, you can see ICE vehicles down about 1.5%, and the electric hybrids, PHEVs, and the pure electric batteries, all positive. What's interesting here, if you go to the next slide, when you look at the fourth quarter, year over year, ICE vehicles are up 3.7% in that quarter relative to the fourth quarter of 2023. Just an interesting data snapshot because maybe it had to do with the election. I don't know, but it seemed to like something that people would find interesting. If you go to the next slide, a lot of people always want to ask about what's the electric percentage of the car park, or the light duty vehicles in operation. And you can see it's still rather low. The blue box on the right shows it's about 1.1% of all the cars in operation today, so pretty low. But if you go to the next slide, 21, this shows new vehicle registrations for BEVs, PHEVs, and also really traditional hybrids, which is a little bit different than a PHEV. But anyway, that's going up. You see the incline, but it has slowed in 2023 to 2024, that adoption or those new vehicle registrations for those types of vehicles. On the next slide, completely behind, shows you new vehicle registration for the same type of vehicles by state. This is up to date for the 2024, as much as I think so, almost to the end of 2024. And then the last one's a very interesting one that you all may have seen before, Jed, is the increase in real world fuel economy, or MPG. And you can see that the without BEVs or PHEVs, the kind of late tan dot, the bottom dot, you'd be about almost 4 gallons lighter, or 3 and 3.6, whatever the case may be, miles per gallon less if you didn't have PHEVs and BEVs. Now, there's a miles per gallon equivalent that has some controversy around it to get to that 28 miles per gallon. But anyway, it's just an interesting thing to discuss and maybe look into further in the future research effort or study group effort, Jed, that you may hold there.
Mm-hmm.
Okay, so with that, we're going to move to propane. And Sean, we have a few slides on propane and just a few slides on lubricants so we can get to Jim.
All right, moving on to slide 26 here, a similar graph and table to what you saw for retail and wholesale motor fuels. We've graphed the last 10 years of transactions in the propane industry. You can see that 2024 was down roughly 10% compared to the 10-year average of 49 deals per year. 2024, we registered 45 deals. And you can see those were pretty evenly distributed across all quarters, a low of 10 in Q3 and a high of 12 in Q1 and Q2. Similar to the convenience store, retail, wholesale motor fuels channel, we saw quite a diverse buyer universe here for the last 10 years, approximately 500 transactions and 152 unique buyers. So just under one unique buyer per 3 transactions. So there still remains a very diverse pool of buyers out there. Varies based upon geography or region a bit, size of the transaction, but you can see it's quite deep and quite diverse. In terms of who's driving consolidation in the propane industry, we divided up into some different groups here. In the top left, you have U.S. public companies. Star Group has probably been the most active of those recently. They will compete for propane-centric opportunities, as well as what we call dual fuel or mixed fuel opportunities, where there might be some propane, some heating oil, some off-road diesel, et cetera. In terms of financial sponsors, in the bottom left quadrant or corner here, you have some established sponsors with platform companies. So Pritzker and EDP, Redwood and Thompson are probably the 2 most active, along with CID backing Letterman's. That's a more recent platform that was established over the last 2 years. So those 3 that we've listed in order, Thompson, EDP, and Letterman's, would be the 3 most active in terms of financial sponsor backed. And then over on the right-hand side of the slide, you have the cooperatives or co-ops. They tend to be a little sleepier in terms of acquisitions, but will do some in their geographies, or sometimes they're just outright acquiring their own members. In terms of large private regionals, of the ones listed here, Blossman and Perico have been the most active. And then in the bottom right corner, you have international companies. Superior has paused propane M&A for the most part. SHV has not done a ton of acquisitions since they first entered North America. So that would leave DCC, who's done a few acquisitions. But overall, the appetite from these 3 international companies has waned in more recent years. On slide 28 here, we wanted to graph U.S. propane inventory that's measured in the x-axis on the left-hand side y-axis on the left-hand side in terms of millions of barrels relative to price, which is on the y-axis on the right-hand side, which is measured in dollars per gallon. And the index we're using is the Mount Belvieu propane price. And as you would expect, there's a negative correlation or inverse relationship, which makes sense here with supply and demand, or you could substitute the word price for demand. So when supply is up, price tends to be down. It is somewhat seasonally dependent, given the propane industry's, push and pull in the heating season of winter. But we thought this was an insightful graph, and you can see again in the blue line the U.S. propane inventory, and then in the gold line is the price.
Okay, and so just being sensitive to time real quick, why don't we go, I'll just real quickly do lubes, which, sorry to shortchange this, but I want to make sure Jim has time, and I'm happy to talk to anybody. Just kind of a real quick overview. There's a lot of activity. Everybody knows this has been a consolidating segment since the late 90s and early 2000s, when the major oil companies really started to consolidate some in those brands. And recently, more pressure on PCMO as demand has gone down, more focus on industrial lubricants. We think that over time, the number of mergers will slow a little bit, but the size of the deals will increase because there's been a lot of consolidation, and there's going to be a power balance shift, we think, to these larger distributors as they become larger. And they're needed more by the manufacturers, just like in the wholesale fuels jobbers have gotten a lot more leverage over their major suppliers. So on the next slide, on this slide here, you'll see that average over the last 10 years, 19 deals a year, the way we classify them. Last 2024, there were 22 transactions, and some of the most active are down in the bottom: Velodyne, PetroChoice, Parkland, and Brentag. So with that, Jed, I think we should be at the end of our portion of the segment.
No, it sounds really good. Thank you for the graphs that you have in there. One question from an audience member who's on the buy side. They're saying we're a relatively small jobber, 20 stores or so. We want to double to 40 in the next few years. What are the essential things that we need to do today to prepare for this, for them, relatively large doubling?
Well, I think they assume they're going to double it. They want to acquire, which is the easier way to double, and to have a very clear criteria in mind of what they are seeking, what type of quality of asset they want, what type of config, all those things that you're seeking. So you can really be bullish on going after what you really want, because to buy anything, you have to have a little bit of animal spirits about you to get the deal. That doesn't mean you have to be reckless, but you have to be aggressive. I would encourage them to have their capital deck lined up with ready to go. People want to know you have the money. You want to be able to show sources, detailed sources and uses. Maybe you have an acquisition line in place with an accordion feature. We can talk to whomever we can help them, whatever. Just give them pure advice, and just be ready to go and be flexible. And don't chase ghost in the purchase agreement, because that will put you at a disadvantage to these larger consolidators who will take risks, because they know that most of the risks today in these transactions, not most, but a lot of the risks that were there in the early 2000s or late 90s, Jed, as you know, with environmental and all the other things, they have been mitigated greatly by the equipment we have today and the insurances that we have today. So I think it's got to be not a reckless mindset, but an aggressive mindset, and be prepared before you get involved in a process.
I appreciate those insights, Spencer's, and thank you, Sean, as well for the insight shared. We'll turn to Jim to give us the legal update and dive into corporate veil issues.
Yeah, thank you, Jed, and thanks, Spencer and Sean. Always really enjoy listening to your presentation. So we're going to move from something that is obviously very heavily data-driven and fact-driven into a much softer area, and that's the corporate veil. And related to that is corporate structure. So very basic, and a lot of you folks, I'm sure, are familiar somewhat with this term, maybe some more than others. It's obviously a highly legal concept, but it's one that has some really impactful real-world implications for the way businesses are structured and operated. At the very basic level, most businesses today, many businesses today, are conducted through an entity, and oftentimes that's an LLC or a corporation. Obviously, there are many other options as well. But one of the main reasons that folks do conduct business in that fashion is to gain the limited liability aspect of the entity. And essentially what that means is that the liabilities and obligations of the entity, of the business, do not flow through to the owners of the company. So that's the very basics of this concept. In a little bit more robust enterprise type structure, where you may have more than one business entity in the enterprise, it can also serve, the corporate veil can also serve to limit or restrict liability between entities that are within that structure. The types of liabilities that we're talking about here can vary quite a bit. It can include contractual liabilities of the entity, for example, debt, rent, vendors, those types of things. It could extend to tort liabilities, such as accidents, negligence, those kinds of things that lead to exposure. And statutory liabilities that maybe that's related to taxes or employee issues. So all kinds of different potential liabilities that an entity or a business may incur through its operation, that this liability shield or the corporate veil is intended to essentially limit to that entity or that business and not have it go away from that. Sean, I think we can go on to the next slide, which just shows, again, that very basic one business entity, one, call it a corporation, owners above it. We're looking to keep the liability from moving from the business entity up to the owners. So this slide obviously just illustrates the super basic concept. And while that can apply to some businesses, many of our clients in the fuel distribution business, and it sounds like probably a number of folks on the line here, operate as part of a larger integrated group of distinct businesses. For example, then an overall group of companies might include a fuel distribution business, maybe a QSR, maybe a retail gas and convenience store business, trucking business, home heating oil, propane supply, any other number of businesses within the overall enterprise. And it can be beneficial for many reasons to structure your enterprise in this fashion with, let's say, for example, a holding company at the top or an administrative services company at the top, with each of the operating companies being wholly owned subsidiaries beneath that. That would be a very simple multi-business structure, and that can be complicated in any number of ways. They don't have to be wholly owned subsidiaries. If there are, other owners or investors that you wanted to bring into one or more of the businesses, that's feasible as well. And there's lots of considerations for setting up the structure. I guess for this purpose today, we're just mostly going to be talking about that somewhat basic structure of a holding company or administrative services company at the top with the actual owners above that. And then, any number of wholly owned subsidiaries below. Yeah, that picture right there, I guess, shows kind of the paradigm that we're thinking of today. Those arrows you can see there would indicate potential liability, and those aren't all of the arrows either. But just to illustrate, there's potential liability moving from a fuel distribution company, for example, up to the holding company, back up to the owners, if things aren't done right, if the corporate veil is not strong. In addition to that, you could have potential liability moving from, again, say the fuel distribution company over to the retail gas and convenience store company, to the trucking company, to the others. So across the subsidiaries is also potential exposure, again, if things aren't kind of set up and operated correctly.
So Jim, the fuel distribution may be its own LLC or S Corp. Retail gas convenience may be its own LLC or S Corp. Is the holding company its own LLC or S Corp?
Typically, yes, it would be. And I'll get into that just a little bit later when we talk about sort of how we can make a structure like this with all the formalities I'm going to talk about, make it feasible, make it workable. But yes, typically that would be its own entity as well.
Okay, and does that provide more protection than just replacing the holding company with owners, which I think a lot of people are structured that way without a technical holding company?
Yeah, I think one of the it's less about additional protection and more about see the admin services pieces there piece there in that box. So what that really is about is trying to as much as I'm going to talk about treating each of those entities at the bottom level as separate companies, respecting the separateness, setting them up separately, operating them separately, etc. There's also an impracticability to that if each one of them, for example, has to handle its own IT and accounting and HR and those kinds of things. So what that holding company or administrative services company often can function as is kind of a repository to provide all of those services to the subsidiaries in a way that doesn't kind of ruin what we're trying to do here with the corporate veil. Does that make sense?
Got it. Yeah. Shared services.
Yep. Shared services. Exactly. So let's see. Moving kind of fast here, but I think, Sean, let's go there. Several goals, I guess, that folks typically may have in mind, and this is only a partial list of those, for setting up a structure like the one we just saw. Again, one of the main ones is going to be to isolate the potential risks and liabilities, not only to prevent those from moving up to the individuals, the owners, but also to isolate the one business from another. At the same time, you want to be able to function efficiently as an integrated enterprise, which we sort of alluded to there a little bit with these shared services. Another goal of setting it up this way can be to more easily facilitate and be prepared for future sales or acquisitions, that should say. So for example, if you decide somewhere along the line that the gas station convenience store piece of your business is not really your strong suit, or you just see an opportunity to sell that particular business at a nice return, then having it kind of set up and operated as its own company, its own entity, makes the sale a lot easier. It also makes an acquisition a lot easier to fold it into an existing company. So that's kind of another goal that some of our clients have in setting up a structure like this. And then another one can be tax considerations, and I will readily admit that that is not my bag. I'm not a tax guy and can't speak too coherently to the deep tax issues, but fortunately we have a strong team here that I lean on for that. But it's here because it's another goal sometimes of what folks are thinking about when they're setting up a structure like this. So again, generally speaking, the law will uphold the limitation of liability feature of corporations, LLCs, similar legal entities. Now, if you're trying to operate as a sole proprietorship or a general partnership, you don't get that limitation of liability, which is why we don't see those forms of business much at all, at least not in this industry. So typically, corporations and LLCs may be a limited partnership. So that's our general starting place, is that it will be upheld, generally speaking. But the question is, can it be attacked? In our world, we call it piercing the veil, and that can happen, or attempts to make that can happen, certainly do occur. And I'm sorry, I'm getting a little feedback, which is distracting me. My apologies. So where we oftentimes will see this is if you have some kind of an incident or an accident or something at one of the companies. Let's just say the trucking company. There's a spill, there's a major spill, or there's an accident that leads to death, something like that. And you'll have an aggressive plaintiff's lawyer get involved, and maybe they see, well, there's great enterprise value here. Maybe this trucking company itself doesn't have a lot of value, or doesn't have what we think are sufficient insurance limits that are going to satisfy the claim we think we have. So let's go after the entire enterprise for this, and that happens pretty frequently. And that just brings to a head this issue of, is one company in the structure, or all of them up and down the chain, liable for the exposure and liabilities and obligations of another? Excuse me. So when that happens, it's going to bring the issue to a head, and the court is going to look at facts and circumstances. So as I mentioned at the beginning of this, the presentation we just saw from Spencer and Sean was very data-driven and fact-driven. This, for better or worse, is a facts and circumstances kind of determination that courts are looking at. You're going to have a little bit of variance from state to state in what the state law is. For the most part, they're going to be looking at the same kinds of factors, but there's no concrete way to say that one particular factor or another is going to sway the court. So really what you're trying to do is get as many good facts in your side of things as you can. So what are these facts and circumstances that the courts tend to look at? Well, one set of them we can kind of categorize into what we would call corporate formalities. So this deals really with kind of the setting up and the operation of the corporate entity. First of all, you want to make sure it's set up in a form that provides limited liability, such as corporation or LLC. But you want to follow what are viewed or termed as corporate formalities. For example, each entity within the structure should have a board of directors or governors. There should be an election of managers or officers at each entity. Annual or periodic board meetings should be held at each entity. separate bank accounts, separate books and records, and then documenting any sharing of funds. Really, the idea is separateness. So is each entity set up separately, and is it operated and functionally running as a separate entity from the others? Now, that, again, does not mean that there can't be any crossover whatsoever. For example, very common in a structure like this for at least some of the folks on the board of directors, some of the managers or officers, to be common from one entity to another. But with the idea that I mentioned before of trying to stack as many good facts as you can on your side, it's also helpful to have some variance there. So maybe it makes sense in one of the companies within the structure for a different person to be on the board of directors, or to have different officers because they're more familiar with that particular business. Again, it's not like you can't have any overlap, but having some variation also helps for sure. Sharing of funds. Oftentimes we'll see within a structure like this, one entity or another is sharing in one fashion or another funds with another. And a lot of times what that is intercompany loans or advances. And from an operational standpoint, that may just be what works. And maybe there may be seasonality needs or things like that, where cash at one company is more abundant than cash at another for a period of time. Those things are fine as well. The less of it that happens, the better. But it's not like it can't be done. I think the key there really is to document it for what it is. If it's an intercompany loan, document it as such in as good of a fashion as you can. I'm not saying you have to draft up loan agreements and notes and all of those kinds of things, but strong documentation showing that it is an advance from one company to another, and then demonstrating that it's paid back. Those all help because, again, the idea is separateness and treating it as separate and acting as if they are separate companies. And if they were unrelated, you would certainly document it and show that this is a loan from company A to company B, and then you would expect it's going to be paid back, and you would document when it is. So sometimes in walking this fine line of we're trying to operate as an integrated enterprise, but we're also trying to stack the good facts showing separateness. Sometimes a starting point for how to think about something is to start by thinking of the companies as being unrelated. Even though they are related, start there and think about, how would I handle this with an unrelated company? And then you can move away from that, because obviously they are related, so there's going to be some terms and conditions that are a little bit different than what you would do with a truly unrelated third party. Let's see, beyond kind of and we're just about done here. Let me get to this question. Isn't the separateness impractical? Yeah, it can certainly feel that way, and it also, I'm sure you'll walk away from this feeling like this is a very gray area, and what am I really supposed to do? I wish I had a great answer for you. I think the answer is, think about your entities' separateness and treating them that way. Think about the starting point of thinking of them as if they were unrelated, and then where it makes sense, for example, HR, accounting, IT, maybe insurance, other things, you can handle those administrative tasks for each of the entities within the structure under just one company. And the key there is to document that arrangement. So we often draft administrative services or shared services agreements for companies in a structure like this. And you want to have the terms of those be as close to third-party types of terms as you can. In the end, there's a lot of different factors the courts are going to look at. There isn't a single factor that's going to be determinative of the issue. But what's important, again, is to just stack as many of the good facts as you can on your side. It looks like we're going to be about out of time.
Quick 2 questions, Jim.
Yep.
Trucking companies, huge risk. A lot of people put those in separate LLCs. They spend a lot of time doing it. Is there actual case law that these things have been tried and they've been shown, yep, we're not going to pierce the corporate veil, that it was, we did all these facts and circumstances to the best of our ability and it stood the test?
Yeah, and I'm not familiar with any cases that are specifically around trucking companies in this industry or anything like that, but certainly there are cases where the attempt to pierce the veil fails. And you also see this come up in the insurance context where, you know, the trucking company, there's an accident there, and the question is whose insurance is going to cover any shortfall that the trucking company itself may have. Can they get to the administrative services company? It's the same type of facts and circumstances type of analysis. And yeah, there are cases where these attempts fail. One of the biggest factors, I think, is really the money. Where folks get in trouble the most is when they sort of start treating company assets as if they are personal. Company funds are treated like the personal checkbook of the owners. And then, you know, other things like, you know, logos, trade names, how are they held out to the public and how are they operated? Those all add up as well.
That makes sense. And one last quick question. I know we got to wrap up here. I've seen some people go to the extreme and they put, you say create separate companies. All right, I'm going to create a separate company for each truck, or I got a convenience store chain and each convenience store I've created a separate LLC for that. Is that advisable to do?
You know, I think at some point you're probably shooting yourself in the foot there. It's not going to be a clear line as to at what point that is, but a clever, probably not even that super clever of a plaintiff's attorney is going to throw that up in front of the court and say, look, they're just trying to essentially defraud creditors or potential creditors. And they've gone overboard, but really, even though that's a separate entity for that truck and that truck and that truck, they all operate in the same exact way. They've got the same, you know, dispatch. The employees don't even really know who they work for. Which truck do I work for? That kind of thing. I think you would be shooting yourself in the foot because it would also be next to impossible to facilitate that. You know, you're having board meetings for every single truck entity and officers and directors and bank accounts. You're going to file probably tax returns for each. Who knows? It I think becomes just unwieldy at some point, and a court is likely to just look through that.
That makes a lot of sense. Well, Jim, thank you so much for this, and the audience for being on the call. Again, to Spencer and to Sean for sharing the M&A update as well. When we sign off, there'll be a very quick survey. I encourage you to fill that out and just let us know what you thought of the webinar. We want to make webinars that are educational and informative to you. Appreciate all the speakers on here, and we'll get the slide deck and the recording out to you. Hope you have a great day. Goodbye.